welcome to the weekly market wrap with Bill Hubard. So, Bill, I guess the first story has to be Bernanke and the FOMC yesterday.
Or is it, I really want to say Friday the 13th, part 2. Yeah. I mean, you know, we thought we'd seen a disaster after the 22nd of May FOMC statement, but I mean, wow, we've seen not even the past 24 hours. I'm just amazed, okay? But I also think it's a horrible thing to say, but I mean, Mr. Bernanke in the press conference yesterday was sort of saying, you know, the economy is sort of putting on the gas and taking your foot off the gas. Well, I think he's taking his eye off the ball. I think he's in a proverbial fog, talking about, you know, the U.S. unemployment rate dropping to, you know, 6.5% below. I mean, I can't see that happening.
You don't think he seemed to have a reasonably rosy picture for the economy that he's starting to pick up, or?
Well,
will that be the key that starts the tapering? I mean, I appreciate even the talk of it is still much later in the year.
Yeah, and I mean, one of the things, again, going into his speech, all right, Fed fund futures were implying no change until probably early-ish third quarter 2015.
Yeah.
Now that still hasn't changed, okay? So we're still going to see funds lower for longer. And also, I mean, all the rates are negative. And I mean, yesterday, I mean, if he was concerned about the bubbles, well, the only bubbles you're going to find out is your bathtub. I mean, the equity bubble's gone, the bond market bubble's gone, commodities got destroyed, even the foreign exchange bubble is gone.
Yeah. So, quite high volume yesterday, really. I mean, I appreciate maybe not so much of the run into the meeting as people were waiting, but certainly afterwards. So if that implies people taking money off the table, where do you think they're going to place it next? Do they wait 2 days and then put it back in?
Exactly. Well, I mean, you know, if we could have had this discussion like towards the end of last year, you know, everybody said, well, you know, we took money out of the markets, but then when everybody realized, well, it's all a negative return, or let's go back 2 years ago, when everybody said, well, gee, maybe we're worried about equities, so let's buy bonds. Well, remember, you know, 2 years ago we were seeing like the lowest level for the gilt 10-year since 1690, and just remember this. You know, we talked about 6 months ago. The Treasury 10-year was at 1.6. Now it's at 2.4. And if everybody's now saying, well, the equity market bubble is over, and I think one of the things, especially here in the UK, the major component that took the FTSE down this morning was a continuing murder of mining and mining-related stocks. You know, with gold more than $50 today, with falling 3 times normal than the 100-day moving average. So it's again, stocks. But I mean, everything is being taken off the table. So you know, by midnight tonight, we'll probably have the largest cash pile, depending on what currency you're in. Like on which it's day one.
I mean, you mentioned the gold bubble. I mean, that's quite interesting. So we talked about before. It's sort of been hovering around that 1400, and then this morning it's probably just above 30.
Yes.
I mean, even made new lows on the sell-off from a month or so ago. What do you make of that? I mean, is there a return for demand there? We seem to have missed the Indian season, the buy season there. Couldn't add in new luster to it, and it's obviously starting to lose it.
Yes.
Certainly, if the US economy is picking up, it's losing.
And one of the things that at least didn't help the move when we got to $1,400 was whether we've seen the Reserve Bank of India changing, you know, the capital gains, and also the moving, you know, buying gold, buying physical gold. Now it'll be quite interesting to see. We may not see that till the beginning of next week, because what we've started to see, at least in the first couple of days this week, the spread between spot gold and physical gold was starting to lose its luster, so to speak, and maybe everybody saying, well, we're waiting to see what Mr. Bernanke. So it'll be quite interesting to see, especially with the Shanghai market. And as I say, we may have to wait till next week to see. You know, at one point it was like a $6 an ounce spread between physical and spot, and it got down below $2 earlier this week. Now, if that starts to move back out again, you know, that could at least help. But I mean, one of the things, I mean, with copper, right? Now we're talking about the housing market, so you know, improving both here and in the U.S. Well, the last time I looked, you know, we weren't making plastic tubing. It was still copper tubing for housing, and yet copper, if you're a technician, had moved into a bear market scenario. Is that because of probably, again, more so what's happening in China? Because we saw this, you know, again, we got the PMI last night, and it's quite interesting because the sell-off after the 22nd of May, we started to blame it on Bernanke, but I think it was more China. Now, the same thing happened last night. We were blaming it on Bernanke, but again, because of Bernanke being in the news, away from China, did anybody really see that data this morning?
Well, certainly it seemed to get hidden in the news.
Yeah.
So gold with no real practical usage, is there room to go lower from here?
I think it probably is. I mean, if you're a technician, again, we'll have to check the charts today, because one of those things, if you happen to go to the loo last night or this morning, all of a sudden we took out almost all the support levels. So now it's a question of how low is low. Yeah. But I mean, then you go back
territory.
Yes, I mean, you go back to whether the Credit Suisse or Citigroup or Goldman, where 3 months ago they were saying it could go much lower. Well, I mean, they were talking like $1,200, $1,100 an ounce. Now, I haven't seen again what happened like with the SDRs or like the gold fund, but we know ETFs and ETPs. We've seen a massive withdrawal of people in those. Now, where they're putting their money in, I don't know, but I mean, I would have to say at least temporarily. And remember, we are getting up to the end of the quarter next week, end of the fiscal year for a lot of people. You can see just a massive move, quote, just into money market funds until we get into the next quarter to see exactly what people want to do. But I mean, you had a number of equity analysts, which I may be a guru on everything else, but I can hardly spell equity, much less understand it. There was, people start saying, well, it's the sell-off that we'd had since the 22nd of May, and FTSE was maybe some FTSE companies were looking good, but the Dow, et cetera, et cetera. Now it's going to be quite interesting to see where the analysts will be once we get into the beginning of the next quarter.
Well, I guess that kind of leads me on a little bit to the question. I feel like I can't let go the other news story in the UK. So he was Osborne and his speech.
Is that Osborne? Are you redoing your house?
But so now, I may be slightly missing the mood that obviously we were experiencing, especially watching the markets last night. But he was obviously talking a reasonably bullish picture.
Yes.
And what do you make of his plans for Lloyd's, for RBS? It sounds like he was happy to sell Lloyd's off at this price.
Yes.
The market hasn't disappointed this morning. It's kind of held the level. So if he has got buying interest and potential, and splitting up RBS, what do you make of those plans?
Well, again, it's one of these things where I have a difficult time with the crossover between economics and politics. And it goes back about 3 years ago, okay? Before we learned that new word Grexit, or Greeksit, however you want to say it, Angela Merkel was in front of the Bundestag or Bundesrat or whatever, and she said, one thing we've got to understand is politicians really don't understand the financial market. Well, if she's willing to say that, we who've been in the financial markets, truly believe that. And so now it's a situation where I think Lloyd's Bank, is a better institution. Because again, RBS has those things we don't like, derivatives and fixed income and all this kind of stuff.
The good, bad bank side of these two investments.
And then it's a question of, I guess where I look at things differently now, living in the country as I have in the last 3.5 years. My little village, we have a Lloyd's Bank, but like 6 or 7 years ago, we had a Lloyd's, a Barclays, and a NatWest. Now we only have a Lloyd's Bank. Okay. Now, right or wrong, it's like post offices. All of a sudden they're disappearing.
Yeah, fits the purpose.
Yes, it does. And I mean, to be honest with you, not on the equity side, but I mean, this was shortly after that slight problem with Lehman Brothers. Well, I just, my wife and I had just sold a flat. And being a bond man, all of a sudden, when I was looking around for something to invest in, I mean, when we're talking Lloyd's Bank bonds, okay, we're trading at 53p on the pound, yielding a nice round, 22.8%, slightly better than the base rate. I mean, so, again, it has nothing to do with the credit. I said, well, if it's like 82% owned by the government, it's like buying a gilt, with 15% better yield on it. So, we own those, and our stockbroker, I know, has conniptions. But as I told him, I said, I don't want to hear another word about this until the 20th of February, until the 50th of February, 2020. He said, well, I said, that's when I'll have my bond repaid. But, if I were looking, from a personal standpoint, I've always been a buyer of Barclays Bank shares. As I say, I would have never touched RBS, but I mean, if there's a chance, if they come in and they want to give a discount, I would buy Lloyd's Bank, because I mean, I see Lloyd's, again, maybe just the people that I know, that I've talked to, and this is not being cruel, it's dull, boring, but it's in safe hands, okay? Where RBS is, say, derivatives and futures and LIBOR and all this kind of stuff. But I think that's positive. But again, I think the market has overreacted. I think Mr. Bernanke, probably did take his tablets yesterday. I mean, I have to agree with Bill.
You looked at it, didn't you?
Yeah.
You come around a bit stronger.
Yeah, I did. I found, if you look at his body language, he seemed very nervous. And look how many times he was taking a glass of water. I mean, the only time he seemed to be, sort of enjoying himself is they asked him why he wasn't going to Jackson Hole. He said, well, been there too many times, I'm going somewhere else. And of course, he passed on whether he's going to be retiring on the 31st of January, which I think he probably will be. I mean, 8 years in this job with,
It's long enough.
yes, it's long enough. But I think the market, I think he was wrong to give the feeling that, we were going to have a positive drop in the unemployment rate. And I mean, I remember, years ago when I was, CNBC, and I was talking to a youngster at that time, and we'd gotten, I think, UK inflation, and the rate had come out at 2.2%, and he was, I said, is that monthly or yearly? He said, well, that's annual rate. I said, well, I'm showing my age. I remember October '79. It was 28.9. That's inflation. And here we have now in the U.S., like the lowest level since George Washington was president, right after the Revolutionary War. And so we got no inflation. We're going to have a continued problem, with employment. And I think we're seeing the same thing in the U.S. as we're seeing here. People will take any job, and look at the spread now between wages and inflation. I think it's like the widest it's been in 40 years. So people, I'll take any job. So, fingers crossed, when the economy comes around, I don't have to look for one, I already have one. And it would not surprise me again next, I expect no better than 7.5% in next month's unemployment number. And again, if people start thinking that it's, good again, could we have another 300,000 or 400,000? People say, well, I think I'll dip my toe.
It does seem amusing that good for the economy all of a sudden is bad for the...
Yes, and that makes no sense. But again, the thing that's scary is, when we've seen these sell-offs before, it was, 15, 20% low volume, but now volume is huge.
Yeah.
And so, is it...
Interesting levels, really.
Yes. So, where does that money go? I think it goes into money market. We may not see any move, because of the quarter end and fiscal year end, next week. We could be sitting here saying, well, where's the money?
Yeah.
I'll give you my NatWest bank account. You can just send it to me.
Okay, many thanks.